Well, we saw interest rates improve nicely over the last couple of weeks. Will that trend continue? Well, let's talk about it. Today is Wednesday, November the 8th. I hope you are doing well. Well, we saw interest rates drop significantly from their highs, y'all. We had seen going back to the 19th of October, 20 days ago, we hit that scary above 8% number. We were at 8.03 in the Mortgage News Daily tracking of national rates, 30-year fixed rate conforming loan. Today, we're at 7.41. So we are improved by about 5/8 of a point over the last 3 weeks. A week ago today, we were at 7.69, so we're about a quarter point, a little over a quarter point better than we were this time last week. That's about the same as we were 30 days ago, y'all. So we have seen nice improvement from the highs that we saw mid-month, mid-October. This really started with a much weaker than expected non-farm payroll report that we got this last week. When you look at some of the internals in that report and you look at revisions downward to the prior 2 months reports, which were quite strong, we talked about the possibility that those prior reports were probably outliers and that we would see more weakness in future reporting. Well, we saw exactly that. When you start breaking down some of the data in that non-farm payroll report, the household survey actually had us losing 348,000 jobs month over month. That's the one that generates the employment rate, which ticked up unexpectedly to 3.9% in that survey. So that is driving bond market rallies. You see that the weakness in that report really takes a lot of the sales out of the possibility that the Fed's going to have justification for a hike again this year. There's still some chance of it at their December meeting. I would not be shocked if the Fed tried to get in one last hike before this year is up. But that NFP report this last week really is going to make it challenging them to find the justification for that. So I think the chances of it are slim at this point. What it's also driven is the possibility, y'all, and some of the internals in that report. If you look at employment over the last 24 months, you see a significant trend downward, a very identifiable trend downward in the strength of the jobs market. That signals to the folks that buy fixed income securities. They look to these instruments as being a safe place for their money, a safe harbor for their money. That's why you hear the term flight to safety when folks start getting concerned about recessionary fears. When you get an NFP as weak as this one was this last week, it does invigorate those fears of coming recession. Folks start parking their money into the fixed income markets. That raises the demand, that raises prices for fixed income securities, and our yields move inverse to that. And that's what you're seeing. That's why we've seen over a half-point improvement in rates over the last few weeks or so. The data is just suggesting that jobs are weakening, the economy is slowing, and we already have numerous reports showing inflation moderating and coming down. So put all of that together, it's a recipe for lower rates. How low will they go? Only the future is going to predict that, folks. I don't think that we're going to be seeing the sixes anytime soon, but I think we've said goodbye to eights for the time being, at least, until something significant changes. As always, I'm going to continue to take a look at this, and anything that changes significantly, y'all, I'll bring it to you. A number of folks did reach out, and I've set up presentations to offices talking about whether or not we're going to see a housing bubble. We saw house prices improve over in the southern zone where Texas is, about 48% over the last 2.5 years or so in value. Is that sustainable? Are we going to see a bubble burst? Got a lot of reasons why I don't think so, y'all. I think we're going to see price increases continue. I think we'll see nice increases year over year, even right now in the current market. So I have a presentation for that. A number of you have already reached out and scheduled appointments for me to present to your offices about why I do not believe we are in a housing bubble. Folks that are waiting, y'all, if we see 5 to 6% appreciation over the next 12 months, if somebody is sitting on the sidelines saying, well, interest rates are really high, I think we're going to see house prices come down, I think we're going to see them go up. I think we could see them go up 5 or 6%. On a $500,000 purchase, y'all, that means that somebody is going to be paying, they're going to lose $25,000 in purchasing power over the next 12 months if we see a 5% increase in home values. So just something to think about. There is a cost to waiting if that bubble is not real. There's a lot of reasons why I don't believe that it is. Would love to come out and present that to your group, and hopefully we can motivate some buyers to move forward rather than waiting and losing out with higher prices down the road. In any event, hope this is helpful for you and for your clients. As always, you've got all my contact info. Stay blessed, stay safe. We will talk to you soon.